think the long end, as I referenced in the first segment, I think the long end it saw its peak last year. I mean, the long bond was up substantially higher than at its peak, where it is right now. And so I think broadly that the long end of the curve is reasonably safe place to be, which is a very strange thing for me to say, because the valuation of it is so terrible relative to inflation. You have a long bond, you know, below 2.5%. You got the inflation rate pushing 8%. But basically, it's because of the economic situation and the uncertainty, and the relative comparison to other bonds in the world, even though that comparison has gotten less favorable for the United States. But I do think that investors, and we've been talking about this in our get-togethers, Scott, for the past few times. That as weird as it sounds, I think investors should own long-term treasuries as part of their portfolio. I own some long-term treasuries as part of my core strategies, and even my flagship fund, and we own the long ones, because they will do well during a turnover in the economy, and certainly if the inflation rate is rated lower as we move forward in the year. So I think those are okay. In fact, I think bonds broadly are sort of okay in spite of their bad valuation. In fact, one area that have not been very enthusiastic about for quite some time is the corporate bond market. The investment-grade corporate bond market, the yields have quietly been going up, and going up faster than Treasury yields, which means their relative spreads are getting wider. And the balance sheets of corporate America are in great shape. The other thing that now has turned into a potential positive with corporate bonds and longer-term treasuries is that duration, interest rate risk isn't a problem at the present time. So corporate balance sheets are in good shape. Corporate bonds have they have a lot of interest rate risk, which hasn't been good, but now it's not being that painful. They have a duration. The LQD ETF at times has a duration of 10, which means it has more interest rate risk than even the 10-year Treasury. But they've gotten cheaper, and credit product broadly has gotten cheaper, even as yields have gone up. So until such time as there's closer to a recession in view, I think it's a reasonable time to be moving into some of these areas that have been widening kind of stealthily in the last several months. So
and this is very interesting.